Okay. So the agenda for this training is basically one to give an introduction on financial modeling and highlight the different elements one need to consider when developing financial modeling. So I will start off with an introduction about our company and also give you a little bit of background on what AgriFrontier does and who we are. Yeah. So, okay. So Agri-Frontier was started back in 2010. We have over 10 years of experience in agribusiness. So what we do is we provide specialized financial and management and business consultancy advice to agri enterprises. So we specialize in this and we help to create world-class farming and also integrated agribusinesses across the different value chain. So we mainly focus in the frontier markets, particularly in Africa. So, yes, so that's a little bit of introduction. So we have a couple of offices in UK, West Africa and Eastern Africa. And over the years, we have conducted a variety of experiences, which includes investment facilitation for a flour company in Ethiopia. We have assisted a company in mergers and acquisition transaction for over 200 million USD for a flour company in Kenya. We have also conducted a variety of feasibility studies in the avocado industry in Kenya. And we have also assisted with setting up a local office in Rwanda. So basically this was for an investment firm that wanted to open up in Rwanda. So we assisted with the registration of the office, creating of the pipeline for this specific company. We have also assisted an investment firm in undertaking investment due diligence in Zambia for a company that they wanted to invest in. So this is a brief summary of the past experiences for Agri-Frontier. So in terms of our services, what we do, Agri-Frontier, so we provide investment support. This include fundraising support, investment readiness support, pipeline development. And through this, we also assist with consulting support. This include feasibility studies, whether a company wants to understand a specific market. We help with conducting the feasibility study for them to understand whether the market they are going to venture in is worthwhile. So we also assist with the business valuation for agribusinesses and also development of strategic plan and financial modeling, which is part of what we are taking through today. Also, in terms of recruitment, we help with executive search for basically the executive team members. We also assist enterprises with setting up of board and also developing a talent recruitment strategy. Through CropNut, we also help enterprises with soil testing and also conducting food safety testing. So over the years, the 10 years of experience we have, we identified that most of the SMEs are experiencing a lot of problems. One, first, they cannot afford to pay for our consulting services. That's why we came up with the Growth Hub that enables us to subsidize our consulting services. So the Growth Hub was launched last year in October. So we support enterprises in 3 phases, which one includes the pre-funding support. Then we do the fundraising support and the post-fundraising support. In terms of the pre-funding support, this is basically to assist enterprises with developing of their business strategies and promote organic and sustainable growth. With this, we assist them, enterprises with developing business plan and financial modeling. We also help them with development of strategic plan and development, conducting market research. We also do mentorship and coaching as they develop their strategies. So we help enterprises to think through the different strategies that they have as an organization. We then assist them with also financial management. Once all this is done and we are satisfied that the enterprise is investment ready, that's when we now move to the next stage of fundraising. So basically for fundraising is we support enterprises with either raising debt or equity. So we help with developing a capital raising plan. We identify different investors and lenders for this specific company. Then from that, we apply for different equity and debts. We also help with managing different and multiple interested investors, and also advise that, on terms and structure that the enterprise might receive from the different investors. And also we help with the enterprise in preparation for due diligence. This mainly involves setting up a data room that will be used in the investment process. Once a business has received the different financing offers, so we help with the reviewing of the term sheet, and also we help with the financial restructuring support. So after the business have received financing, we now assist the enterprise with operationalizing their strategic business plan. This mainly involves mentorship and coaching also. We go deep down and understand what are the challenges the business might have in executing this. So we mentor the business on how they are able to operationalize this business plan. We also identify any management gaps that the business might have, and also help with the recruitment of the necessary management team that the business might require. So in that introduction about the Growth Hub, I'll hand it over to my colleague George, who will take us through on the fundamentals of financial modeling, and help us to learn more about what are the different things you need to have when you're developing a financial model.
Thank you, Penina, for that introduction into AgriFrontier and the Growth Hub. My name is George Kanyaki, a manager with AgriFrontier East Africa, and then I'll be taking you through a couple of slides just to introduce this topic, financial modeling. But before we go to the details around financial modeling, it is important to first understand the type of agribusiness that you are operating and where it falls within the value chain and the business model that you are operating, so that you're able to understand the nature and the characteristics of a business that will help you create assumptions around revenue and cost that are tailored and suited to a specific business model. Next slide. Thank you. So the various business models that we currently have, some of them include cropping, livestock, processing, and smallholder integrated models. And as I mentioned, the business model determines the interaction between revenue streams and cost structures that will help us to derive different assumptions to develop our financial model. So when you look at the agribusiness value chain, we have enterprises or agribusinesses that operate across different nodes of the value chain. We have those that are in the input sector, there are those that are in the production, processing, all the way to retail and end consumption. And it is important to understand where your business falls in, at which specific point of the value chain, what business model you're using, so that you're able to determine how to build in your financial model. And we'll be seeing that as we go to the next slide. So here I'll take us through a cropping business model, and we'll get to see what are some of the characteristics that cropping business models have, and how this is inputted into the financial model. So for cropping businesses, these are those that entail, growing of plants for either food, fodder, or other uses. And this can be further split into short life cycle crops and long life cycle crops. So when you look at short life cycle crops, for example, maize, beans, onion, watermelon, and such like, we have found that these have modest capital requirements, have revenues that are generated within each cycle of planting because they have shorter seasons. They would require replanting at every growing cycle, and they would have access to a wide range of funding sources. Whereas long life cycle crops have high initial capital requirements. They generate revenues several years after planting, and they do not require replanting every year, save for gapping and filling in those gaps that, say, for example, a tree did not grow or was damaged because of one reason or another. They are either funded through long-term investments or patient capital. And some of the examples would include macadamia, avocado, tea, and coffee. So when you look at these two examples, short life cycle and long life cycle crops, their assumptions and their model will be slightly different because maize and beans would generate revenue every year, but macadamia, avocado will generate revenues after 3, 4, 5 years, depending on their maturity. And for that reason, if you are operating a business that is dealing in long life cycle crops, you would require working capital or funding to help you through the initial years where you're not able to realize revenue. But when you look at short life cycle crops, you'd look for capital to help you buy inputs, fertilizer, chemicals, seeds that you'd use to in your planting, because you're doing different seasons in any given year. Next slide. When we come to the processing business models, these are those that transform produce into different forms, either through milling, drying, crushing, juicing, and extraction. We have different levels of processing. There are those that carry primary they carry out primary processing, which would entail either cleaning and packaging the produce and then selling it. But then there are others that will go to an extra level, and these are the secondary processors, and they would mill, dry, crush, and transform the produce into a different form. For example, a company that buys mangoes or other fruits and processes these to produce juice for sale to customers. They generate profits through value addition. We've seen that the inputs of a processing business would largely be outputs from a cropping or a livestock business. And for these enterprises, they would require high capital investment, especially where specialized equipment and buildings would be required. And when you compare, say, the balance sheet of a processing business compared to one that is carrying out cropping, there would be different fundamentals. For example, their property, their plant and equipment value would be higher than a cropping business. Land could also be higher, especially where the processing business has its own land as compared to a cropping business that may have leased land for farming purposes. And so the value of fixed assets on a balance sheet in the form of plant and machinery would be higher compared to cropping business. Next slide, please. Thank you. The third category is the smallholder integrated model, which entails sourcing of produce from smallholder farmers and mainly to reduce supply risk. The models take different forms depending on the level of support that is provided by an off-taker business, and we'll get to see that in the next slide. So we have different types of smallholder integrated businesses. So one of them is the centralized model, where an off-taker or a company buys their produce, whether it is tea, coffee, macadamia, avocado, from many smallholder farmers, and mostly for the purposes of value addition, either processing or packing. And we've seen that in this particular model, the off-taker does not engage in primary production, but rely on smallholder farmers for the produce that they're buying. We have a nucleus estate model, which is a combination of the centralized model, but now the off-taker has a nucleus farm. They have their own land where they're also doing their own production, and they supplement this through purchasing from smallholder farmers. They often sometimes also provide training to their contracted farmers. The third model is the multi-party model that involves agreements with parties beyond the two primary players, which is the off-taker and the farmers. So for example, there may be an agreement with a financing institution to provide financing, to provide working capital. There would be an agreement with cooperatives for produce aggregation. There may be agreements with input providers, whether it be fertilizer, chemicals, such that they are able to provide these inputs to the to the smallholder farmers, so that they're able to improve their yields and get better yield. And the last model is the informal model, which is usually characterized by informal production contracts between an off-taker business and smallholder farmers. And so it is important to understand the specific considerations for each business model and company operations in the building of a financial model. While we do say that it is important for, or rather, engaging smallholder farmers reduces their supply risk, the other risk that would be faced by this particular model, and they will depend on the model that you choose, whether centralized, nuclear estate, multi-party, or informal. And it is important to understand what risks these are and how you can mitigate against them, even as you build your financial model. And so it is important to understand where your business model lies and how you can tailor, how you can develop your assumptions in a way that will suit that particular business model. And so with that, I will hand over to Mercy to introduce us to what is a financial model. Thank you.
Sorry about that. Hello, everyone. My name is Mercy Ndunge. I am Senior Agribusiness Consultant with Agri-Frontier. It's a pleasure to meet you all today. And if you have questions, you can continue sharing them on the chat box. We will respond them immediately after we have finalized on the presentation. So, so the next few slides will be on what is the financial model, and just it labels the structure of how we expect a good financial model to look like. So I'll start with what is a financial model. I will personally define it as a decision-making tool that is used to that estimates the financial performance of a project or a business by taking into account all relevant factors, growth and risk assumptions, and interpreting their impacts. So what are some of the decisions that we can use to derive from financial modeling? So one of them will be the financial requirements. So we have, when you're starting a new business, for example, let's say you're setting up, you want to do maize farming. And ideally, what a financial model will do for you is provide you with the cost, your revenue. It allows you to visualize the entire project or business in terms of the revenue and the cost. Then you can have starting new lines of business within a company. Let's say you are doing maize farming, then you decide you maybe want to introduce beans. So it will allow you to visualize this. Then there's undertaking expansion activities of existing business. Let's say you are doing the maize farming again, so and you want to introduce maybe milling. So that will allow you to assess the financial requirements of those various divisions. We can go to the next slide. So the benefits of a financial model, as I discussed earlier, so one of the most important one is budgeting and forecasting. That is what I think I intimated from the three important examples that I've given in terms of decision making. So one of them is budgeting and forecasting. So that will help you to give the present I mean by your historicals, the past, and the present I mean by your management accounts, the past, your historicals, that is what you have had before, that let's say for the last 3 years, then your future, how do you want this different cost or revenue lines to grow? So that is one of the benefits of financial modeling. The other one, it will allow you to assess the company's valuation. Let's say you want to maybe get in new shareholders. So you want to issue new shares. So what is going to happen? The financial model will help you estimate the value of your business. There are different ways of valuing a business. We'll go into details in our next training sessions on that. So, and then there's it improves and provides an in-depth understanding of a business. So what this allows you, it allows you also to analyze your business. For example, you can tell your profitability using the various ratios. So that is one thing, and you can be able to see the various numbers on the financial model. So that allows you to get a deeper and a better understanding of your business. The other one is facilitates periodic review of the business performance. So it allows you to analyze, or for example, a good analysis will be variance analysis. Like you can say, for example, this month I did this much. So what did I do last month or maybe last year? So it allows you to review the business performance and make more informed decisions. Next slide. So the process, the financial modeling process. So we have entry of historical data, that is your management accounts, your historical data. Let's say you've been existing like for 3 years. So your company was incorporated 3 years ago. So you have those financial statements. So that is the first step will be keying them in and having that in place. Then you have maybe management accounts, key that in, and then analysis of historical performance. That's where I mentioned you can analyze the variances. You can see the growth trends of maybe your sales. So that is the next step. This will allow you to grow the various. For example, let's say you are working with last year, the previous year. Let's say I'm going to take a scenario of 2021, 2022, and maybe you are also there in 2019. So in 2019, let's say you made revenues of 1 million. In 2021, you made 2 million. In 2022, you made maybe 3 million. So with that trend, it will allow you analyze and make more informed decisions in terms of what assumptions you're going to use. So the next one is gathering of assumptions for forecasting. So the analysis of the historical performance allows you to come up with the various assumptions from now the trends that you've observed from each line item, that is both the revenue, your revenue lines as well as the cost lines. Then the other one is forecast the financial statements using the assumption. This is where you'll have your income statement, your balance sheet, and your cash flow statement. So from the three, from the assumptions, you are able to derive the three. That is the income statement, the balance sheet, and the cash flow statements. And the other one is future business risk assessment. So you can be able to assess your business risk from now, the three that you have, and you can play with different scenarios just to see how they will play out. Then the last one is performance of sensitivity analysis. Next slide. So I'm not going to repeat. So I think we have gone through this in the last slide where we gather historical performance, we analyze historical performance, then we make informed assumptions from the trends that we observe from the income, the cost, then we create a forecast, then you review and play with the different scenarios. Next slide. The key components of a financial model. So when you are creating a financial model, you need to visualize your entire how you want this to play out. So you need to, the first thing that I think my colleague George mentioned is you need to visualize your business model. Like for various enterprises, let's say, for example, cropping, the model will be totally different. The concept will be totally different. And the same way with processing, it will be very different from the cropping business model. So you need to ensure that you know all this and visualize this for your financial model. So in terms of assumptions, so each business is very different from the other one. And then the revenue stream. So you need also, as I said earlier, you need to define, for example, are you selling beans only, or are you doing maize and beans? So this has to be clear. Then your financial model has to show all this. Then the cost structure. We have the operating cost and the investment cost. So investment cost will be your capex requirements that you require, and operating cost will be probably the overhead cost, your indirect cost, your direct cost. So all this has to be factored in the financial model. Next slide. Now these are from the three that we have just given in the last slide. We have given the assumptions, the revenue streams, and the cost structure. From the three, you'll be able to derive the income statement, the balance sheet, and the next one is the cash flow statement. So the income statement is basically, it shows the business income and cost of a given period of time. So basically it shows the profitability. This is where you are able to derive your gross profit margin, your earnings before tax and depreciation. You are also able to derive the net income margin and other important or relevant operating margins. For the balance sheet, this shows it helps us understand the health of the business. So it shows what your business owns, that's the assets, what it owes, the liabilities, that is to your suppliers, for example, and then the money that you have invested into the business. So this may be in terms of shareholding, your share equity, the shareholders' equity. Next slide. So finally, not finally, the next one is the cash flow statement. So we have, so what is a cash flow statement? A cash flow statement shows the cash inflows and outflows of a business for a given period. So, so basically it's divided into three categories, whereby you have operating activities. These are your day-to-day operation, and this is where you will find your model is accounting for the working capital requirements. So different this in terms of working capital requirements, what do I mean? So we have payables, we have inventory, we have inventory, then we have receivables. Those are data. So this is where you will come and it shows you how much money, for example, you are getting from your data at this particular period. How much do you owe your suppliers at this particular period? How much money do you require to buy your inventory at this particular period? So this will be shown in the cash flow statement. Then we under the operating activities. Then we have investing activities. Then this is where we have cash inflows and outflows from purchase or sale of assets. So that is where the model will show that. Then we have financing activities. Financing activities, basically it shows the inflows and outflows in relation to financing. This can either be in debt or in equity. So that is captured there. In terms of debt, we have under financing activities, we'll have money the receipt of money. It will show the receipt of money, and then it will also show when you make the various payments, for example, for the loan. The next slide. And then we have supporting schedules. These are now that they play a role in the three statements that I've just mentioned. So they inform the numbers that are there or play a key role in informing some of the numbers that are there. So we have a loan schedule, we have the asset schedule, and then we have scenario and ratio analysis. So these are important for the financial model. So the last one is elements of a good financial model. So after we have gone through all that, I will say a good financial model will be easy enough for anyone in your organization to understand, yet detailed enough that it can account for most complex business situations. Because I understand businesses keep on changing from time to time. So it should be easy, yes, so that you can, let's say you have recruited somebody new into the business, maybe he's serving as maybe your finance controller, and the financial model should be easy for him or her to use without actually just without coming to you or having to refer to you from time to time. So it should be easy for anyone in your company to understand just after a couple of minutes of looking into it. Then it should be well structured. Then it should have a good and simple layout. There should be consistency all throughout the model. If you're using blue, let's say for your column headings, it should be blue all throughout. And maybe, for example, for the blue for focus, then maybe green for the others, just not something that does not look good. So it should be consistency, there's consistency and well organized. Then the other one is flexible. You should be able to quickly make changes, and at the same time, this model should retain its complete complexity. So, and this is where your assumptions, how you key in your assumption will play a key role on how flexible is the financial model. So how you play with your assumptions during keying in is what will help determine the flexibility of the financial model. Then the other one is make focus drivers and future assumptions clear and realistic. So one of the things I think I've come across most financial models is how some are over ambitious and not realistic. So that's why I've said it is very important when you are analyzing it, observe the trends. When you're analyzing your historical performance, observe the trends, make sure that, for example, we cannot say you are moving from 3 million to 8 million with the existing business. So you need to project, maybe let's say you're moving from 3 million to 4 million in terms of sales, and then from there grow it realistically. Don't be so ambitious. The other one is highlight important items fiscal officers care about. So the tips, the takeaways will be break your business operations into simple chunks. Like, for example, visualize, as I had mentioned, visualize the business. If you're doing, let's say, maize farming, you visualize what are the inputs I require. I require a land. Have I been able to get this land? What payment, what option, what ownership option do I have? Am I leasing? Am I renting? All these things. Do I own this piece of land? You need to consider that. The next step. If I'm planting maize, do I have enough water or am I going to depend on irrigation? All these things have to be well thought around. In terms of transportation, how am I making sure that these goods are reaching my customers? So you need to break this down into simple chunks for you to be able to build the financial model. And then the other one, create all steps before you begin. Yeah, so after visualizing, you create the different steps. That's the assumptions, the revenue stream, the cost structure, the income statement, the balance sheet, the cash flows. You need to have this all put somewhere in your Excel sheet before you begin. Then, and this will help you not to forget. So the other one is have a clear picture of how your model should look like. Yeah, I think that now repeats all that you have mentioned. And thank you for the time. And yes, I hope you have learned a lot.
Yes, thank you, Mercy, for that. Yeah, so now we'll go to the next session of question and answer. So if you have any questions, kindly type them on the chat box. And yeah, also if you have any comments, please do so. Yeah. Okay. So the first question we have is whether this session is going to be recorded and uploaded on YouTube. Yes. All the webinars we will conduct we are recorded and uploaded on YouTube. So for this, basically it was an introduction of financial modeling. We will have subsequent training on financial modeling, as we could not cover all the elements of financial modeling, and also assist you with step-by-step analysis on how to maybe create assumptions, or how to develop an income statement or a balance sheet. So all this training will come later on. We will take you through a financial model for an agribusiness company later on different webinars. But for next month, we will start off with fundamentals of business planning. So essentially, the training will be to educate you on how you can develop a bankable business plan. So we have a whole lot of plan in terms of the different webinars that we'll conduct over the year. So we aim to have at least one webinar every single month. So yes, so we have a question from someone. So how big should my business be to need a financial model? I'll table that question to George.
Thank you, Penina, and thank you for that question. So I would say that if you have any, or if you're doing any agribusiness, any business, whether be it, cropping, livestock farming, different levels of maybe aggregation, we have processing, we have trading, we have export. I would say that you would need a financial model for you to be able to, one, assess, the performance of your business over the next, say, 5 years. You may also need it to, look for funding, because I would assume that for you to be in business, your goals would be to expand, either in terms of your market, in terms of your operations, and you'll need a financial model to be able to assist you determine the different funding requirements, either for expansion or even during your day-to-day business. Say, for example, there's an asset that perhaps you need to buy at the end of the year, say October, November, December. Your model should be able to show that in that particular month, you'll need to either inject X amount of dollars or X amount of shillings into your business to be able to purchase an asset, or even to finance working capital requirements, or even to engage and hire new staff. So I would say that we would all need a financial model.
Okay, thank you. We have another question. So some are startups, they have no historical data. What base would you advise to use for the forecasting? So I'll table that also to George.
Thank you for that question. So yes, so as I think Mercy was explaining in terms of how you're building your assumptions for business with historical data, you may use that. You may use that for the trajectory or the performance indicators, the growth indicators, to forecast your performance over the next 5 years. Well, that is correct for an existing business. For a new business, for a startup, you may want to look at the different indicators, or the different, the different growth indicators of your business. Say if you are selling, a fast moving, or you are in the FMCG sector within the agribusiness industry, and so your sales could be pegged on the growth patterns of the country. Say, for example, is it being driven by, say, rise in middle-class income? Is it being driven by, say, growth in population? You can use some of these metrics, say, for example, percentage increase in middle-class income, percentage increase in the growth population, to help you derive your assumptions and forecast your performance. But then some of them, and for example, in a processing business, your inputs would be guided by the processing facility that you are say installing. Say if you're doing maize processing for animal feed, or even for maize flour, and you have installed a facility that is, say, running say 2 to 5 tons per hour, then that in itself will be able to determine how much inputs you're going to need, how much output, or how much maize flour you're going to produce at any given time, and it will help you to forecast your model. And so it will be important to understand where you fall, what is your business model, and we can be able to advise you on how to forecast, especially for startups. Thank you.
Okay, thank you for that, George. The next question is, what digital tools should one be familiar with before embarking on financial modeling? So for a starter, you don't need to be have any advanced like technical tools. So the only thing you need to have knowledge on is basically Excel, because most of the financial models are done on Excel workings. So for that, you just need to either learn the different shortcuts for financial modeling, V8 VBA or V8 VLOOKUP, some of the tools or techniques you need to learn from Excel. So the next question is in terms of ratios. So what are some of the ratios you can calculate for financial modeling? I'll table that to Mercy.
I just think before I go to the question on ratios, I'd like also to respond on some of what are some of the digital tools you should embark on before doing your financial modeling. So at Agri-Frontier, we have a training module for financial modeling for agribusinesses. So that's one of the tools. You can register with us for that training. And then where we'll give you homework, then it will be more of interactive interactive session where you'll get to ask and we'll respond and take you through the entire, ensure that you understand financial modeling. Another tool that is available for you, I think I've seen one before under the corporate finance institution, there is financial modeling. So you can go there and register for financial modeling. They provide different courses, and all these courses will enable you to produce or build good financial models. The other one was on the ratios that are available. So they are that you're able to use the ratios that you're able to get from the financial model. So we have profitability ratios, that is gross margin, net income margin, the EBITDA margin. Then we have other ratios like liquidity ratios. And then this one will be debt to equity ratio. Yes, debt to equity ratio. So there are a couple. There are many that you can be able to get from your financial model. Yeah, we will share this in detail in the next training session.
Yeah, thank you for that. Yeah, so any more questions? Yeah. Okay. So there have been no any other questions. We will end the webinar there, but feel free to contact on our website at agrigrowthhub.com. Either write to us at info@agrifrontier.growthhub, agrifrontiergrowthhub.com, or text us on the mobile phone number highlighted above. So thank you for your time, and for more subsequent webinars, we will share invites shortly, and we also a link of the same is on our LinkedIn handle. We have the fundamental of business, financial how to develop a bankable business model. on 28th of March next month. So we look forward to hosting you in the next webinar, and also highlighting on how we can create bankable business plan. So thank you for your time. Do have a lovely day ahead.
Thank you. Have a good day.